All right, let's get right into it. We're talking about precious metals. You know, the assets that are supposed to be the bedrock of stability in any portfolio. Well, recently, that bedrock didn't just crack, it completely shattered. We're going to break down exactly what happened, why it happened, and what it all means for you. And no, I'm not being dramatic here. We're talking about a sudden, massive price collapse for gold and silver, the classic safe havens. It was the kind of sharp, completely unexpected drop that sends traders scrambling and has investors everywhere asking, what just happened?
I mean, to put this into perspective, just look at silver. On the Multi-Commodity Exchange of India, prices literally plummeted by almost 27,000 rupees per kilogram in a single day. That is a staggering drop, and it came right after a huge collapse in global prices too.
Now, gold didn't get away scot-free, though its losses were, let's say, a bit more contained. It saw a drop of about 3%. Now, that's still a big deal for an asset like gold, but it's nothing compared to silver's freefall. And that difference is a really key part of this whole story. So the big question is,
what on earth could cause such a violent downturn in assets that are supposed to be stable? Well, turns out it wasn't just one thing. It was more like a perfect storm of factors. And we're going to unpack them one by one, starting with the biggest driver of them all.
So if you're looking for the #1 reason for this crash, look no further than the strengthening US dollar. You could almost call it the main antagonist in this story. See, when the dollar flexes its muscles, other assets often get pushed down, and precious metals are especially sensitive to its every move.
At the time this all went down, the dollar had climbed to a near 2-week high. And here's where it gets interesting, because there's a direct inverse relationship at play. Gold and silver are priced in US dollars all over the world, so a stronger dollar has an immediate chilling effect on their demand.
Okay, so let's walk through this chain reaction. First, the dollar's value goes up. Simple enough. But that means for an investor holding, say, euros or yen, it suddenly gets more expensive to buy that same ounce of gold or silver. So what happens? Well, global demand starts to fall off. And with less demand, you guessed it, prices crash. It's a classic example of how currency markets can throw a wrench into commodities.
But, a strong dollar wasn't the whole story. There were a couple of other key things happening in the background that basically added fuel to the fire, making precious metals look even less appealing.
Specifically, we saw things calming down on two major geopolitical fronts. First, there was some surprisingly positive talks between the US and China, with word that China might start buying more US farm products. And at the same time, tensions cooled between the US and Iran as they agreed to hold talks. All of a sudden, the world stage felt just a little bit calmer. And this gets to the very heart of what a safe haven asset is. See, investors usually pile into gold and silver when the world feels turbulent and uncertain. So when those geopolitical tensions start to ease up, well, the need for that safety net just isn't as strong. Demand drops and prices follow right behind.
Now, of course, this crash didn't just stop with the price of the raw metals. Oh no. It sent some pretty powerful ripples through the entire investment world, especially hitting the funds that are directly tied to gold and silver.
The impact on exchange-traded funds, or ETFs, was immediate and, well, pretty stark. You can see it right here. Silver ETFs took a massive 15% hit. Meanwhile, gold ETFs saw a more modest 3% drop, which lines up pretty closely with what the metals themselves did.
And if we look at the specific numbers, it tells a pretty painful story for anyone invested. The gross silver ETF, for example, traded more than 10% lower, and at one point it even hit a low of just 228 rupees per unit. It's really a brutal reminder of how much more volatile silver can be. People say it's like gold but on steroids. It soars higher when things are good, but man, it falls so much harder on the way down.
So, after seeing these absolutely wild swings and understanding what was behind them, the obvious question for any investor is, what in the world am I supposed to do right now? Well, let's take a look at what the experts are saying.
The consensus from market experts is, frankly, overwhelmingly clear and very cautious. Their advice isn't to go out and buy the dip or try to time the bottom. No. Instead, it's a direct warning. Stay on the sidelines. The market is just too choppy, and the smartest move right now is to wait for things to calm down.
So ultimately, the big takeaway here is really just one word: patience. When you're facing these kinds of sharp corrections, making an impulsive, emotional decision is probably the biggest risk you can take. The expert advice boils down to a very simple strategy: watch, wait, and let the dust settle before you even think about making your next move.
And all of this leaves us with a really fascinating question to think about. We've just seen how quickly traditional safe havens can become sources of major volatility themselves. In a global economy that's this interconnected and moves this fast, it kind of forces us to reconsider the whole definition of a safe investment. What does safety truly look like in today's market?
Like the video, share it with your friends, and subscribe to Equicom Insights today.